The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello, welcome to School Box Europe. I'm Ben Boulos with Steve Cedric, and these are your headlines. Brent crude spikes to $100 a barrel on renewed Middle East uncertainty. Equity and debt markets sell off on both sides of the Atlantic. European shares posting their biggest loss in 2 weeks as German yields hit their highest level in a decade and a half. President Trump's latest round of tariffs has come into effect, with most major trading partners affected. EU Foreign Policy Chief Kaja Kallas criticises the move, saying it's a negative surprise.
Shares in SAP seen hiring pre-market despite the German software giant trimming its full-year profit target, but its cloud order backlog jumps 26%. We'll speak to the SAP CFO Dominic Assam later this hour. And Volkswagen shares, meanwhile, seen lower in pre-market trade after the German auto giant says it expects sales to fall up to 3% this year. The CFO, Arno Antlitz, will join us just after 8 a.m. London time. Hey, here's the thought, everybody. You don't think the tariff stuff over here is designed so that people don't look over here at the cost of oil and the cost of gasoline and what's going on with the war, which isn't going as quickly as perhaps the administration hoped? You? No? Not doing this to distract from this? No? Okay, just my idea. Anyway, Brent crude prices are holding steady. I mean, it's oscillating. It was 99.99 a second ago. Now it's 100.2. It's $100 a barrel after shooting up 7% on Thursday. In fact, hang on a second. What have we done this week? We are up 7% yesterday, but I mean, it's double-digit inclines for the week as well. Shooting 7% yesterday after Houthi rebels, who are, of course, an Iranian proxy, attacked tankers off Saudi Arabia. The Houthis' intervention crystallized concerns that have been building for weeks since the US resumed military strikes in Iran. WTI has climbed over 30% in July. We're at our highest level since May, nearing a 40% gain for the month. 40% gain for the month. So all those tepid, weakish CPI figures that have just come through on both sides of the Atlantic, what's going to happen to those next time round? I think we all know if we stay here, don't we? President Trump says the US is close to making a decision on a potential, quote, massive attack on Iran, telling Axios it would be bigger than ever before. The US leader went on to claim Iran wants to negotiate, but they hadn't received enough pain yet. His comments come as American forces carry out a fresh round of strikes on Iranian targets for the 13th straight night. Dan, I am clearly not a military expert. I've studied military history, but that does not make me an expert. But one thing I'm slightly concerned about is if you were going to do something that was really big militarily, would you tell the opposition before you did it?
Not necessarily. And at the same time as well, Steve, if the Iranians wanted to negotiate, then they would be negotiating, not striking ships in Bab el-Mandeb via the Houthis or threatening retaliation for the president's latest threat. So, of course, we have seen oil prices soaring on confirmation of attacks of those tankers in the Red Sea. Yemen's Houthis hitting Saudi vessels as part of their blockade that was put in force earlier this week, threatening the route that Saudi Arabia has been using to bypass the effectively closed Strait of Hormuz, and also taking more barrels of oil offline. Now, President Trump says if the Houthis fire again, the US is going to hold Iran responsible, and he's also promising major military punishment as well on both. He also says any damage to cargo ships will now be paid for with Iranian money, referring to frozen Iranian assets. And then on top of that, there's also this new interview with Axios. President Trump says he's now seriously considering restarting major combat operations against Iran. The president says he is considering a massive attack that is bigger than ever before. He told Axios he's close to making a decision. Now, also overnight, a 13th consecutive night of strikes, with Iranian media reporting missiles on Qeshm Island in the Strait of Hormuz. Iran also hitting back at US sites in Jordan and Kuwait this week. Jordan saying it has intercepted all but one of 10 missiles and drones being fired at them. And then, of course, we're also tracking developments on the Saudi nuclear file as well. And somewhat of a twist in the Saudi nuclear deal. President Trump also posting overnight that the deal includes no enrichment of material and is totally subject now to Saudi Arabia joining the Abraham Accords. Of course, earlier reports suggest the text includes a joint study on future enrichment and no link to Israel. The White House now says the deal is still being finalized. I've spoken with senior sources inside Saudi Arabia in the last 24 hours who say their position hasn't necessarily changed. No normalization without an irreversible path to a Palestinian state. So the White House saying that the current US position here is that the negotiation is not finished. You heard the press secretary, Caroline Leavitt, say this deal is contingent on the condition of the Saudis normalizing with Israel as far as the president is concerned, and also suggested that this normalization requirement could still be added. But of course, this is quite a complex situation and really, another issue that the president is putting on his plate as he tries to navigate this conflict, which has now expanded into two fronts, not just Hormuz, but now the Bab el-Mandeb, and of course, direct strikes on Iran as well. Now, of course, he's bombing one country for their nuclear program while also dangling the carrot in front of Saudi Arabia, attempting to get this deal over the line, the Biden administration era deal that would have given the Saudis that civilian nuclear program in exchange for Israeli normalization. It seems unlikely that the kingdom would actually go ahead of this without an agreement on a US defense pact, without concrete lines towards what would be a Palestinian state, and additional carrots as well, including perhaps even US technology or investment ties. So where this has all come from is a little unclear at this point as well.
Dan, superb as ever. I want to talk about Saudi oil and something you've been touching on a lot in the last few days as well. So, viewers, feel free to get a map up. I've got one up. In fact, I've got two up at the moment, because basically the east-west pipeline from the east of Saudi to the west has been a lifeline. Dan, you know this. I'm just explaining to myself and others. To Yanbu, which is the offloading port. So 5 million barrels a day, roughly, you've been telling us, have been going that way as well. Now, everybody, take a look at where that is and where it has this very thin choke point right where Yemen meets the Horn of Africa as well, pretty much as well. Dan, the problem here is the lifeline that has been this east-west pipeline is in jeopardy. And that is why the oil prices hit $100 a barrel. Just tell us a bit more about this.
Right. So if you look at the map here, basically you have Saudi Arabia. Over on the right is the entrance point to the Strait of Hormuz, which is down to the south. The Strait of Hormuz remains effectively closed. That would be the primary transit route for a lot of Saudi oil moving from the coastline there via ships to customers in Asia and beyond. The pipeline alternative goes to Yanbu, which is over on the other side of the map. That's over on the left-hand side. The only way to get oil out of Yanbu via that east-west pipeline, which is already the backup, is to go south through the Bab el-Mandeb or north through the Suez Canal. But of course, VLCCs, really large crude carriers, very large crude carriers, can't necessarily go north. And it also adds to the transit time, it adds to the insurance costs, it increased the overall expense of moving those vessels around. So this is a really serious problem. When you have both of those choke points, here you go, on the map on your screen, outlines this well. Those two X points mark really the only way you can get waterborne crude out of the entire Gulf region. And when they're both effectively shut off, of course, it creates major issues for energy markets, as we have seen unfold over the last few months. I spoke with Josh Young at Bison Interest this morning. He says if the situation persists, then we could potentially see oil retesting 2008 highs. That would be up near $150 a barrel. And of course, adjusted for inflation, he even suggested we could see oil testing $200 a barrel and beyond. It's not just the physical supply disruption that's impacting this market. At the same time as well, you also have really low inventories, not just in the SPR, but elsewhere around the world, and of course, other major issues that are compounding what is a real crisis in the oil and energy markets at the moment. So analysts suggesting to me this week, including Amrita Sen at Energy Aspects on Monday, that oil would cross this 100 USD mark, which it has, but also kind of saying, look, why isn't oil trading higher in this environment as well, given just how stressed the system is right now with so much output offline and physical barrels being disrupted?
You are brilliant at your craft as well. And I have to say, viewers are probably doing the same as I am, just thinking, OK, right, so how deep is the Suez Canal at its deepest point, and how deep is the draft of a VLCC, the big crude ships as well? And I bet you loads of viewers are doing the same as I just did as well. So the Suez Canal has a maximum depth of 24 metres, which is 79 feet, which means fully laden vessels with drafts up to 20 metres, which is 66 feet, according to the American Nautical Services, can get through. But as you quite rightly say, a fully loaded VLCC, which are the big crude carrying ships, has a draft of up to 22 metres. And everyone can say that's just too tight for comfort in parts of the Suez Canal. Brilliant work, Daniel. Thank you. Really absolutely fascinating. And all the kind of things we get to have a think about in our job makes it just so interesting for us and hopefully for the viewer as well. Thanks, Dan. Right, Ben.
Well, the oil price is really causing concerns, but let me take you to, well, we can call it our wall of worries, because there's a whole confluence of events that has markets on edge as we hurtle towards the end of the week. As we mentioned, Brent stands at around $100 a barrel, pushing up inflation expectations, and those worries are being borne out, particularly in fixed income. Look at that, the yields on 10-year treasuries at their highest level since the middle of January 2025, right before President Trump returned to the White House. In Germany, the 10-year Bund yield hit a 15-year high ahead of yesterday's ECB meeting. Meanwhile, concerns over capex among hyperscalers saw a sell-off in tech stocks, sending the Nasdaq more than 2% lower. In fact, Mag 7 stocks suffered their worst one-day drop since the US tariff announcement back in April last year. The sell-off wiped out $797 billion in market value as Wall Street grows increasingly concerned about capex spend among big tech. Alphabet and Tesla, which reported earnings earlier this week, both pledged to invest billions of dollars in artificial intelligence and related infrastructure. Meanwhile, AMD CEO Lisa Su told our US colleagues she remains bullish on AI demand going forward.
This is like an incredible moment for AI. We look at our markets, spend time with our customers all the time, and from what we see today, the market for high performance and AI computing over the next 4 or 5 years is going to reach $2 trillion of TAM and market opportunities.
Well, let me run you through the numbers from the markets on Wall Street at the close of the Thursday session, and all of them finished the day in the red at the Nasdaq, leading the benchmarks lower, closing more than 0.2% down. The impact of the fall in the share price of Alphabet and Tesla really weighing on the markets. You may have caught it a moment ago, but just to recap, Tesla tumbled 15% and Alphabet lost 7% on the day. This is around those concerns about the capex on AI infrastructure and build out after the guidance was increased for how much will be spent on those investments. So that was the picture on US markets. This is what's happening in the Asian markets at the moment, and that negative sentiment really filtering through. I should have said, actually, the losses yesterday put the Wall Street benchmarks on course for a weekly loss. The Asian markets, they've had a bit of a tumultuous week, but the combination of factors, the higher oil price weighing on some of those economies that are very much dependent on energy imports. And the Kospi, again, at one point during trading, the sidecar was triggered, halting automatic trading there. Still, it is now off by almost 6%, affected by the AI wobble, the tech concerns, given that some of the big chip makers, SK Hynix, Samsung, make up the bulk, the lion's share of the Korean market, but losses to be found on other equities in Asia as well. And Steve, the thing I find quite interesting about that is how we've seen the chip makers, semiconductor makers, lose value, the share price falling, when the hyperscalers are announcing even more spending? Because I would take that to mean that the hyperscalers are pouring money into buying memory chips and semiconductors. So why then would the semiconductor names fall? Surely that means they've got more money coming their way. But I know it's very much it's not as clear cut as that. There's a lot of other factors involved. People, the sentiment may be filtering through just because it's connected to AI.
There's a lot of things going on here. One is it's very simple. Let's tie everything together. If you've got the price of oil going up and you've got the price of goods going up for US importers and consumers because of tariffs being put on for all kinds of reasons, and we can talk about the whys and wherefores of that as well, that means that inflation remains higher. That means the cost of money remains higher as well. And the cost of money for the people borrowing now in the bond market or in other mechanisms to finance what you're talking about as well in many cases is going through the roof. I'll give you a great example. There's a great FT piece talking about the cost of the Meta, which is its debt. Borrowing costs are higher in latest $12 billion data center financing deal as well. Yields of more than 7% on some of the offerings there as well. So it's very simple in many ways. The cost of financing is going up. The route to profitability is becoming more opaque. And again, we haven't even mentioned moonshot and the Chinese models that are coming to the fore, which people are beginning to get concerned about. So yes, the spending is going up, but the ultimate route to profitability is clearly not going to be linear. And in the meantime, the cost of financing is going up as well. The other thing I'll point out is hold your horses. We've come a long way. What percentage is the S&P off its record high? What is the cataclysmic decline we've seen on the S&P from its record high? Bearing in mind it's had this stratospheric rally as well. I know the answer. It's 2.8%. It's on your next page. Yeah, 2.8% down from its record high as well. So yes, there are stocks that are coming down. And I'll give you another example. Google has had a terrible few days. I mean, it's come down from $400 down to $317. I'm not saying that's not a significant decline, but its 52-week low is $187 compared with the current closing price of $317. Still not a bad return if you're an investor rather than a trader.
And I think the other thing that's worth pointing out is how quickly the jump in the commodity price filters through to the US consumer. Average for a gallon of gas already up 15 cents from a week ago. The average now at more than $4 again. $4, just shy of $4.10. So, of course, that then has a knock-on effect.
And before the drumbeat of war, it was $2.92. I've done my math. End of last year, start of this year, it was $2.92 a gallon of gasoline, regular grade.
And I think there may be something in the question you posed at the very start of the programme about whether all these new tariffs that have been announced are designed to perhaps shift attention away from matters like that. Coming up on the show, President Trump's latest tariff blitz, I was just mentioning, has come into effect with most major trading partners in the crosshairs. We'll bring you the latest. Plus, we'll dig into Q2 numbers from Volkswagen as the beleaguered German automaker abandons hope for any sales growth this year. We'll hear from the CFO, Arno Antlitz, just after 8 o'clock this morning, London time. And SAP's Chief Financial Officer, Dominic Hassan, joins us right after the break.
Executive Decisions is the new podcast from CNBC where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. The US government has finalised new tariffs to replace the temporary measures implemented after the Supreme Court struck down Trump's sweeping global measures in February. The levies, which range from 10 to 12.5%, come in after an investigation to remove products made with alleged forced labour in the supply chain. The new tariffs come into effect today and will include the likes of UK, Canada, the EU, Mexico and others. When you're surprised that someone's surprised? Well, I'm surprised that Kaja Kallas is surprised, because she is surprised. The EU's chief diplomat said the new tariffs were not really grounded, as she questioned the forced labour rationale behind them. She added, here we go, that she was surprised by the move. Given that the EU has kept its side of the trade deal with the US. Let's move on. Let's get to Giorgio Pradelli, who is the CEO of EFG International. Hi, Giorgio. How are you?
Hi. Thank you for having me. Very well.
Are you surprised that I'm not surprised that... no, I am surprised that Kaja Kallas is surprised about this as well. It's just ongoing, isn't it? Something we all have to live with, don't we?
Well, I guess everybody's surprised about something, and it is not surprising to see that the world is this, I would say, state of affair, which is quite complex, I would say.
And that's great for EFG International if you can deliver the goods for your clients as well. I notice that actually in 2026 you're seeing a big increase in AUM as well. Why are people parking more money with the likes of EFG?
Well, I think that, we have come up with this concept of wealth on the move. We see that during times of geopolitical tensions, private banking is a sort of geopolitical risk diversification. In the old days, people used to move money among financial institutions, asset classes. Now they are diversifying across financial centers, and they are also diversifying, their families, in the sense that their families are moving. So we see that there is a lot of acceleration in terms of cross-border flows. We are doing very, very well. We were growing over 6%. As you said, we crossed the 200 billion marks in terms of AUM. And we see that actually clients are looking for safe havens in this complex
Very interested in your many parts of that answer, the first answer. But you're talking about families are looking to move around as well, move their money to different jurisdictions as well. What is this, some form of global tax arbitrage?
No, I think that the tax, there are situations, and obviously in this country there are discussions about that. And
is that why you're here?
No. I love London. I'm always here because our investors are here.
It's always nice to see a high net worth individual coming here still.
Yeah, so no, fiscal, I think, obviously is a part of the equation, but people are clearly taking consideration about safety and diversifying. Obviously, many Europeans are going to Asia, many Asians are coming over to Europe. People are going to New Zealand. If you look about the worst case scenario, Latin Americans are coming back to Europe. So there is a lot of diversification across financial centers.
Giorgio, I know from your trading update that in terms of net new assets,
yes.
As you say, all business regions geographically generated net new assets in the first half of this year. The biggest was continental Europe and the Middle East. Of course, there's huge uncertainty in the Middle East. Some of the wealth that people have there is reliant on oil revenues, and we have seen that massively disrupted. How concerned are you about the potential impact of the Middle East situation on one of those, what is the most crucial region for you?
Well, obviously, the situation in the Middle East is complicated. We have a presence in Dubai, so for us, given also the recent narrative, safety is the number one priority for our people. But regarding business and regarding the flows we see, we don't have a booking center in Dubai, so obviously the assets of our clients are booked either in Switzerland, London, or Singapore. And clearly what we see is that people are assessing where to move their assets. Globally, the impact on markets, obviously with the oil over 100, the issue is an impact on inflation and bonds and rates. And we see that at the moment rates are going up, and this is obviously inflation is going up, and this obviously has an impact on markets generally.
I mean, given all the uncertainty and worries about the Middle East, thank goodness there's some stability in a reliable trading partner with America. Oh, hang on, actually. This whole swathe of new tariffs. Interested to get your take on it as a board member of the Swiss America Chamber of Commerce. What kind of conversations are you having on behalf of the Swiss businesses that you represent who want to do trade with America and are coming up with, they're up against 10% tariffs, and then the tariffs would expire, but then suddenly there's 10 to 12.5% tariffs. What are those discussions you're having like?
Well, this is a difficult situation for sure. I would say that clearly the US is the biggest export market individually. The EU as a bloc is bigger, but individual markets, the US is the biggest export market for Switzerland. Clearly the only way is to continue the dialogue. There is no other way, and not to be surprised as we have seen just now about these developments. You know, we have to go through, we need to be very calm, we need to try to find solutions. This is the environment we live in.
You talked about the let's try again.
About what?
Diversifier in terms of geography.
Yes.
But you haven't talked about what you're actually putting the money into as well. Where is the diversity? You talked about bond yields going up, so it's not quite playing the safe haven that we always hoped it would be in an inflationary environment as well. Equities, again, we can make a good case for. So where is the great place to be putting a diversified portfolio at the moment?
Well, I think you mentioned the word. I think the only real advice we're giving to clients now is to diversify, because the visibility is extremely low. Asset classes are challenged. Clearly, we have seen a great run up to now, but you need to become a bit more defensive and maintain diversification.
In terms of, you are a private bank as well, but in terms of the private markets as well, I guess a lot of your clients are still looking at those rather than the public markets. And let's be honest about it, they've had a very checkered performance over the last 18 months. People are concerned about the redemptions. Maybe some of these products were missold to clients who didn't quite understand the time frame of which they take to come to fruition as well. What is your attitude towards private market investment for your clients?
No, look, very wealthy clients, ultra net worth individuals, they like private markets. They are entrepreneurs. The majority of our clients are entrepreneurs, so they understand private markets. As you said, I think it is very clear, though, that the liquidity of those markets is completely different than public markets. So when I hear things like semi-liquid, there is no such thing, right? It's either liquid
Thank you, Giorgio.
or is not liquid.
Could not agree
right?
with what a load of old nonsense.
It is very important that the clients know what they're doing, and obviously we have to advise the clients in the proper way. But if you have a long time horizon, and the majority of our clients, they look across generations. So if you think in generations, private markets are a great instrument.
Okay,
if you want,
it's a family show, so I just wanted to know when you first saw the term semi-liquid, what did you think? Probably the same as I did. Family show.
Semi-liquid doesn't exist.